In today's incredibly complex world, how do global companies not just survive, but really thrive? We're talking ground wars, culture wars, trade wars, extreme weather, AI popping up everywhere.
Yeah, it's a maze out there.
Right. So what critical insights are they uncovering to navigate all this uncertainty? And maybe more importantly, what can you learn from their playbook?
It's the fundamental question, isn't it? For any leader right now, you've got to understand these interconnected risks, these opportunities, and they're changing almost daily.
Absolutely. And that's precisely what we're digging into today. We're doing a deep dive into Marsh McLennan's recent results and their strategic outlook. They're a top global professional services firm.
Mhm.
Our mission here is to pull out the really key nuggets from their Q2 2025 earnings call, the press release. Think of this as your shortcut, really. Your inside look at the global economy through their eyes.
Because they're advising clients everywhere on risk, strategy, people. So they have a pretty unique vantage point. We'll unpack their financials, sure, but also the big macro trends they're seeing.
And how they're turning challenges into opportunities. That's the crucial bit.
Exactly. For their clients and, well, for themselves too.
And, here's where I think it gets really fascinating. We'll look at their solid financials, yes, but also these huge geopolitical shifts, the economic bumps,
Uh-huh.
the surprising tax on the U.S. economy. Wait till you hear about that. Plus, the global insurance markets, how their different businesses are adapting.
Insurance brokerage, consulting.
Right. And the big one, how they're using AI and their own data to build, well, what they call a competitive moat.
A defensible position in this crazy market.
So, okay, let's start with the performance. How did Marsh McLennan actually do in Q2 2025, given everything we just talked about?
Well, they framed it as a solid second quarter. Performance was pretty much tracking with their own expectations. They knew the macro environment was shifting, anticipated some impacts.
Solid sounds good in this climate. What do the numbers actually look like?
Pretty strong, actually. Consolidated revenue grew 12%. That's up to $7.0 billion compared to Q2 last year.
12% top line.
Okay. But maybe more importantly, the underlying revenue,
Yeah.
stripping out acquisitions, currency swings, that increased 4% for the quarter.
Yeah.
Which is healthy organic growth.
Right, that 4% gives a cleaner picture. What about profit?
Adjusted operating income, that climbed 14% from a year ago, hit $2.1 billion, and their adjusted operating margin actually expanded a bit by 50 basis points, so 0.5% up to 29.5%.
Margin expansion is always good to see. And earnings per share.
Adjusted EPS grew 11%, came in at $2.72. So, yeah, solid numbers across the board.
And beyond just the P&L, they're making moves with their capital too, right?
Yeah.
That often signals confidence.
Absolutely. Big news on the dividend front. They announced a 10% increase to the quarterly dividend.
10%.
Yep, up to 90 cents per share. And get this, it's their 16th consecutive year raising the dividend.
16 years. Wow. That speaks volumes about consistency, doesn't it?
It really does. Plus, they bought back $300 million of their own shares during the quarter. That's $600 million in share repurchases for the first half of 2025.
Okay, so strong operating results, returning cash to shareholders. What about the first half overall? Does the picture hold up?
It does. Looking at the first 6 months, underlying revenue growth was also 4%. Adjusted operating income grew 11% to $4.3 billion, and adjusted EPS was up 8% to $5.78.
So, pulling it all together, these aren't just numbers on a page. They show a major player really navigating this tough climate effectively, holding their own, even expanding.
Right. It underscores resilience, finding growth, even when things feel really uncertain out there.
And that uncertainty, that's kind of the key theme, isn't it? They mentioned the global economic outlook remains, quote, uncertain heading into the back half of 25.
That's the prevailing sentiment everywhere, it seems. And they pointed to some really complex operating conditions driving that.
Yeah, the list was pretty striking. Ground wars, culture wars, trade wars, extreme weather events, which feel increasingly common.
Definitely. And then there's AI, both the massive opportunities and, well, the significant risks that come with its rapid development.
It really feels like businesses are juggling more major disruptions simultaneously than ever before.
No doubt. And they actually shared some data on this. Oliver Wyman, that's their consulting arm, teamed up with the New York Stock Exchange, surveyed 155 CEOs.
Oh, interesting. What did they find?
Get this, 89% rated geopolitics, trade, and industrial policies as a risk to their company.
89%. Wow.
And that figure jumped 20 percentage points just from 2024. It shows how much this stuff is top of mind for CEOs right now.
So what are these CEOs focusing on then?
primarily. Finding growth in what feels like a slowing economy, navigating that complex geopolitical landscape we mentioned, all while keeping a really tight rein on costs. They're spending more time on the near-term stuff, the immediate fires.
Makes sense. You have to deal with what's right in front of you. But Marsh McLennan sees this whole environment as an opportunity, right? For them to step in and help clients.
Exactly. It's challenging, sure, but it's also where their advice becomes crucial. They're guiding clients on near-term tactics and long-term strategy, helping them find growth, build resilience.
Analyzing supply chains, which are still so tangled.
Right. And even thinking through how AI impacts the workforce, it's a broad range of support.
So really, this paints a picture of what's keeping business leaders up at night. These aren't abstract risks. They're shaping decisions daily across every industry.
And companies like Marsh McLennan are positioned right at that intersection, helping turn those big challenges into potential opportunities. It's about providing that specific expertise.
Okay, so we have the global picture, the uncertainty, but they also flag a really specific issue hitting hard right here in the U.S., something they called, what was it, effectively imposing a tax on our economy.
Yeah, that was a powerful phrase. They're talking about excessive litigation, what they see as abuse of the U.S. legal system. And it's causing a major surge in U.S. liability insurance costs.
A tax on the economy? That sounds pretty significant. How does that work?
Well, the U.S. already has the highest liability insurance rates globally. So when those costs escalate further, it makes it harder for companies to invest to grow.
And ultimately, those costs get passed on to consumers, right?
That's usually how it goes, yeah. They argued that the tort system, our system for civil lawsuits and compensation, while intended to be fair, it's too often, in their view, backed by this huge growing industry of outside investors, litigation funding.
So third parties investing in lawsuits for profit.
Exactly. And the result, they claim, is that the actual injured parties often see less than half of the final settlement awards.
Less than half? Wow. Where's the rest going?
Well, presumably to legal fees, the funders.
Yeah.
It raises questions about the efficiency and fairness of the system.
Yeah.
And then there are these nuclear verdicts.
Right, I saw that term, cases exceeding $100 million.
Yeah. And according to the U.S. Chamber of Commerce data they cited, those have grown 400% over the last decade.
400%, that's staggering.
It is. And it just encourages more lawsuits, bigger verdicts.
Yeah.
It creates this cycle that drives up insurance costs dramatically.
So what's the actual impact on insurance bids?
Severe. In 2024, U.S. liability insurance saw its worst adverse reserve development, basically meaning insurers had to set aside way more money for future claims than they expected since the 2008 financial crisis.
Worse than '08 levels for that specific line.
For that specific line, yeah.
Yeah.
More than double the previous year's development. And over the last decade, U.S. excess casualty rates, that's the insurance that kicks in above primary limits, they're up a cumulative 150%.
150%. Just wow, that's a massive cost increase.
It's a huge burden. They even mentioned a specific legislative effort, an amendment from Senator Tillis about changing tax policy for litigation financing.
Oh, yeah. What was the issue there?
The disparity.
Yeah.
Right now, the injured person pays ordinary income tax on their settlement. But the litigation funder, they pay capital gains tax, which is usually lower. And a foreign investor funding the suit often pays zero U.S. tax.
Huh. That doesn't quite seem balanced, does it?
They called it a missed opportunity to address that. It's clear Marsh McLennan is pushing for reform here, working with the business community, policymakers, because they see it as a major drag.
It really does sound like a hidden cost affecting everyone, businesses and consumers. When you think about a legal system designed for justice turning into this kind of financial weight, it's pretty striking.
It definitely stands out. The scale of it, the systemic nature they describe.
Yeah, that explosion in nuclear verdicts and the whole litigation funding industry, it makes you wonder, doesn't it? Where's the line between justice and, well, just industry?
A tough question, and it certainly casts a shadow over U.S. liability insurance.
Okay, so that's a big factor in the U.S., but what about the broader global insurance market? Is it all doom and gloom, or is it more nuanced?
It's definitely more nuanced. Actually, overall, global commercial insurance rates decreased 4% in Q2.
It decreased after everything we just heard about U.S. liability.
Yeah, it follows a 3% decline in Q1 as well. Now, this is based on the Marsh Global Insurance Market Index, which does skew towards larger accounts. But still, a downward trend overall.
So what's driving that decrease then?
It's largely property insurance. Rates there have softened quite a bit, which is interesting actually given the surge in catastrophe losses we saw in the first half of the year.
Huh. So property rates are down despite more disasters. How does that work?
More capital coming into the market, perhaps.
Yeah.
Competition, we'll probably touch on that. But regionally, the picture in Q2 was mixed. The U.S. overall was flat.
Flat. Okay. Not down, but not up like liability.
Right. But Latin America, Europe, the UK, Asia, they were all down mid-single digits. In the Pacific region, down double digits.
Quite a bit of variation. What about specific lines of insurance year over year?
Okay, so global property down 7%. Global casualty, though, increased 4%. And within that, U.S. excess casualty was up that whopping 18% we talked about.
There's that litigation effect again.
Clearly. But workers' compensation was actually down 4%. Financial and professional liability lines down 4% globally. And cyber rates continued their slide, down 7%.
Cyber down 7%. That market has been stabilizing a bit then.
Seems so, yeah. It's been a roller coaster, but definitely softening compared to a couple of years ago.
What about reinsurance? You know, insurance for insurance companies, that market's been really tight.
It has been, but even there, things softened a bit at the mid-year renewals. Rates decreased, maybe 5 to 15%, for programs that didn't have major losses.
Okay, so some relief there. What caused that softening?
Well, client demand was described as moderate, but that was offset because reinsurers actually increased their capacity, they were willing to write more business, and there was more activity in cat bonds.
Ah, catastrophe bonds, where insurers transfer risk to capital markets.
Exactly. They mentioned cedent cat bond issuance was up, basically insurance companies selling more of these bonds. And that market is actually on pace for a record year.
A record year for cat bonds. How big?
Over 50 new bonds just in the first half, involving around $17 billion of limit. Guy Carpenter, Marsh McLennan's reinsurance broker, was involved in 14 of those issuances just in Q2.
So lots of capital markets money flowing in to cover catastrophe risk.
Which helps explain some of the property rate softening, perhaps. But even with that, they emphasized that the overall cost of risk is rising in the U.S., especially when you factor in extreme weather, those healthcare risks.
Right, so it's complex, some areas softening, driven by capital flows maybe, but underlying risks and certain lines like U.S. liability are still pushing costs up significantly.
Precisely. It's not a simple up or down story. You really have to look under the hood at the different forces at play. Legal systems, natural disasters, capital availability.
Okay, that makes sense. It's a dynamic market. So against that backdrop, let's drill down into Marsh McLennan's own businesses. How did the different segments perform? This is where that diversification really shows, I imagine.
It really does. Overall, consolidated underlying growth, as we said, was driven by risk and insurance services, up 4% underlying, and consulting, up 3% underlying.
So let's break down risk and insurance services first. That includes Marsh, their main brokerage, right?
Correct. Marsh itself had a strong quarter. Revenue up 18% overall, which includes acquisitions, but that underlying growth was 5%.
5% underlying for Marsh. Decent. How did that look geographically?
U.S. and Canada grew 4% underlying, but international was really humming underlying growth. It was 7%. They called it excellent.
7% internationally. Where was that coming from?
EME, Europe, Middle East, Africa up 8%, Asia Pacific up 4%, Latin America up 3%. It reflects really strong new business wins, they said, and strength in specific areas like construction, cyber, credit specialties.
Okay.
FinPro lines, capital markets work, and their employee benefits business was also highlighted as strong.
All right, so good momentum there. What about Guy Carpenter, the reinsurance side? How did they fare with that softening reinsurance market we discussed?
They actually did quite well, considering. Revenue up 7% overall, 5% underlying.
5% underlying growth in reinsurance, even with rates softening. That's pretty resilient.
It is, especially since they were comping against really strong growth, 11% underlying in Q2 last year. They saw good international growth, a lot of activity in insurance-linked securities, ILS.
Those cat bonds and similar instruments.
And new opportunities in their capital and advisory practice. That's where they help clients raise capital, advise on M&A for managing general agents, MGAs.
Right, those specialized intermediaries.
Yeah. Interestingly, they noted demand for property catastrophe reinsurance eased a bit at the mid-year renewal, but even so, they placed an additional $5 billion of property cat limit for clients. So still significant activity.
Okay, so RIS looking pretty solid. What about the consulting side? Mercer and Oliver Wyman.
Right. Mercer's overall revenue was up 9%, again boosted by acquisitions. The underlying growth was 3%.
3% for Mercer. How did that break down within Mercer? They have health, wealth, career.
Yeah, health was the strongest, up 7% underlying. Medical inflation is driving demand for advice on plan design, cost control. Although they noted most of that business is fixed fee, so inflation doesn't automatically mean higher commissions for them.
Gotcha. What about wealth? That includes their big asset management business.
Wealth grew 2% underlying. Now, their assets under management, AUM, were actually up a huge 36% year over year to $670 billion.
Whoa, $670 billion AUM. Why only 2% underlying growth then?
Good question. It's because only a specific part of their wealth business, the outsourced chief investment officer or OCIO segment, is directly compensated based on AUM. So while market gains and acquisitions boosted AUM massively, it didn't translate proportionally to underlying revenue for the whole segment.
Okay, so structure matters there.
Definitely. Plus, they mentioned the ongoing structural decline in traditional defined benefit pension plans and slower demand for project work due to macro uncertainty, especially in the US and UK. People pausing big consulting projects.
But DC plans, like 401ks, are still growing.
Yes, defined contribution solutions continue to grow.
Okay, and the third Mercer leg, career.
That one actually decreased 5% underlying. It's more sensitive to the economy, more project-based.
Down 5%. What drove that softness?
Primarily the U.S. economic uncertainty, making clients hesitant about big HR tech projects. And also, low voluntary employee turnover.
Fewer people quitting means less urgency for companies to revamp their rewards and talent strategies?
Exactly. Though they did say international growth helped offset some of that U.S. weakness.
All right, so Mercer's a bit mixed. What about Oliver Wyman, the strategy and management consulting arm?
Oliver Wyman's revenue was up 5% overall, 3% underlying. Led by solid growth in the U.S., actually.
3% underlying. How does that compare to their usual performance?
They position themselves as typically being a mid to high single-digit growth business through the cycle. So 3% is maybe a bit on the lower end of that range, but still positive.
What trends are helping them? And what's holding them back?
Positive trends. Things like clients hunting for growth, focusing on efficiency, developing AI strategies, rethinking supply chains, the energy transition. Lots of big strategic questions.
Makes sense. And the softer areas?
Lower M&A activity is hitting their private capital work and some economic consulting, and just general client uncertainty, leading to a bit of a wait-and-see approach on some projects.
Geographically, any standout?
Strong growth reported in the Americas, Europe, and the Middle East. And pretty diversified growth across industries: insurance, asset management, transportation, tech.
Okay, so across both consulting businesses, a bit of pressure from the macro environment, particularly on project-based work. They mentioned a specific percentage of their revenue being more exposed.
Yeah, they estimated about 15 to 20% of their total revenue base is, quote, even more exposed to softer moments of the economy, primarily that project-based discretionary consulting work.
So looking at this whole segment breakdown, it really highlights that diversification, doesn't it? Even when parts like career consulting face headwinds, strengths in RIS or health consulting can balance things out.
Absolutely. It's a key part of their resilience. Managing that portfolio of services across different cycles and economic sensitivities is crucial. It's a lesson for any business, really.
Definitely. Now, a theme that seemed to cut across all their businesses was AI, artificial intelligence. There was a lot of talk about that.
Oh, yeah. A huge amount of excitement, you could really tell. They're clearly focused on moving quickly, using AI internally for efficiency, generating better insights.
So it's not just talk, they're actively implementing it.
Seems so. They mentioned their central tech team is providing tools for learning, experimenting, rolling out broad-based training to get colleagues comfortable using these new AI tools.
That internal adoption piece is so important. What about client-facing applications? How is it showing up in their services? Let's start with Mercer.
Mercer is introducing what they call agentic AI interfaces. Think AI chatbots or assistants built into their platforms. One example is ADA on their Talent All Access portal.
ADA, what does it do?
It lets clients interact with Mercer's data. Think compensation benchmarks, benefit guidelines worldwide in a more conversational way, querying it live, asking questions.
Instead of just looking up static reports.
Exactly. They expect this enhanced interaction will actually increase demand for the data itself. It makes it more accessible, more useful.
Interesting. What about Oliver Wyman? They're the strategy consultants.
They said about 25 to 30% of their work already involves advanced analytics and AI. And generative AI is now, quote, turbocharging that.
Turbocharging, so it's accelerating their existing capabilities.
And they're heavily involved in advising clients on AI, everything from helping governments design national AI strategies to helping companies build totally new AI-driven businesses or re-engineer their processes.
And being part of the bigger Marsh McLennan group helps them there.
They think so, yes. Gives them scale, better tools, more buying power than smaller, standalone consulting firms when it comes to investing in AI capabilities. A real advantage, they called it.
Okay, makes sense. Now, Marsh, the insurance broker, how are they using AI? Seems like a huge opportunity with all the data they must have.
Absolutely massive. They highlighted their Centris portal. It uses AI to give clients really deep visibility into their supply chains.
Supply chains again, helping with all that disruption we talked about.
Exactly. Tariffs, weather, geopolitics. AI helps analyze those complex risks and impacts. They also have their Blue Eye suite of analytics.
Blue Eye, what's special about that?
It's built on their unique data trove. They mention analyzing $1.12 trillion in premium, over $100 billion in claims data. That scale gives them insights nobody else really has.
$1 trillion in premium analyzed. That's incredible data. How are they using AI with it?
Well, one example they gave. They've layered an agentic tool, again, think sophisticated AI interface, over their claims database.
So clients can directly query the claims data.
Yeah. Ask questions like, how quickly does insurer X typically pay claims like mine? Or what are the latest trends in settlement values for this type of incident? They called it a very powerful tool for client negotiations with insurers.
I bet. Giving clients that kind of insight directly, that changes the game.
It really does. And Guy Carpenter, on the reinsurance side, sees analytics and AI as maybe the most important thing they do. It's value beyond just placing reinsurance deals.
How do they see AI making the biggest impact in reinsurance?
Managing change. Helping clients model catastrophe risk, especially with future climate change impacts. Building proprietary risk models using AI. That's where they see the real differentiation happening.
So across the board, it sounds like AI isn't just an add-on, it's becoming core to their value proposition, leveraging that unique data.
That's the key takeaway.
Yeah.
They explicitly said their unique data sets, capacity to invest, and the progress we've made so far create a huge moat around their business.
A huge moat, making it tough for competitors, especially tech startups, to catch up.
That's the claim. It raises that big question, doesn't it?
Yeah.
In a world drowning in data, how do you actually use it strategically with AI to build a truly defensible competitive advantage like they seem to be doing?
Yeah, it's not just having data, it's the combination of unique data, the investment capacity, and the AI tools to make sense of it all.
Exactly. It suggests a combination is going to be critical for market leadership going forward. How effectively you can leverage AI on top of proprietary insights and how fast you can adapt.
So wrapping this deep dive up, Marsh McLennan really does provide this fascinating window into the global economy, doesn't it?
Absolutely.
We've gone through their solid Q2 numbers, the complicated macro landscape they're operating in, that eye-opening tax from U.S. litigation, the nuances in the insurance markets, how their different businesses are performing. But what really stands out, I think, is that strategic embrace of AI.
Yeah. Using that unique data, fostering that internal learning culture, really turning challenges into potential advantages.
So hopefully you listening now have a much richer understanding of how a global leader like this is adapting, innovating in such a dynamic, uncertain world.
It's a complex picture, but understanding how they navigate it offers real insights.
Which leads to our final thought for you. What is Marsh McLennan's really detailed approach to tackling these huge global risks, geopolitics, litigation, climate change? What does it tell you about how any business, big or small, can build resilience and maybe even find opportunity in this increasingly volatile future?
It certainly gives us a lot to chew on, doesn't it? Understanding the risks, yes, but also constantly looking for the opportunities hidden within them.
Definitely something to think about. Thank you for joining us on this deep dive. Until next time, keep digging for those insights.